This is the Twin Cities Real Estate Investing Show. Real stories, real success in Twin Cities real estate. Join your hosts, Adam Tafel and Tim Swierczek, as they dive into the world of Twin Cities real estate investing. Together, they share valuable insights and practical tips to help both new and seasoned investors navigate the Minneapolis-St. Paul market. With a focus on relatable stories from real people, this show will empower you with the knowledge and confidence to thrive in your investing journey. Guys, take it from here.
What's up, Tim?
Hey, buddy. How you doing?
Good. Oh, man. I wrote down how to pronounce his name. Do you remember? We have James Faillettaz today.
Yeah, there you go.
This is a wild story.
It is. He was extremely candid, which I just appreciate so much.
Yeah.
And it's kind of like during the episode, I mentioned that it's like the anti-bigger pockets. And he was very much willing to dig deep into what mistakes he made and just went right there from the get-go. And obviously, I mean, he didn't actually talk a lot about how successful he was. And 32 units with the kind of cash flow that they're spitting off and everything else. I suspect there was a lot of success there that he didn't mention, and I just thought it was a really cool episode that I think is very impactful.
Yeah, and I didn't get his age. He mentioned it sounded like he was only 24 3 years ago.
Based on everything he said, I calculated 29, but I don't know.
It's pretty damn good for 29.
Might even be 20. Yeah, it might be younger, but yeah.
Yeah, I mean, it's this episode is a little bit of what not to do, right?
Kind of. He was,
totally.
He dreamed big from the start, and he went for it, and he realized that he made some mistakes, and he pivoted, and it's, I don't even know if I'd say that. I mean, in some ways, yes, right? I mean, he talks about his mistakes, but gosh, you're not going to be successful without mistakes. So I don't think you have to be so afraid. You and I deal with those people all the time that are afraid just to buy a duplex. Yet everyone they know is a homeowner that doesn't even receive rent on their home. So
right. I think, it was a good episode, and it certainly made me think about the way I do certain things, of how I could be more focused and organized. And he really is a humble guy, because you're not going to hear a lot of like you said, not a lot of talking about his accomplishments, but lots of distractions. I think that's what I would summarize the episode.
Let's let the episode speak for itself.
Cool. Here's James. Welcome to the Twin Cities Real Estate Investing Show, brought to you by Shook. Shook is the all-in-one platform to help you manage your rentals, built for real estate investors just like us. Shook features maintenance and expense tracking, including tenant-generated maintenance tickets and an IRS-aligned expense tracker. At just $5 a unit per month, it's worth checking out shookrentals.com. That's SHUK rentals.com, or booking a live demo in the show notes. Now, on to the episode. Investors, if a deal gets messy, call Network Title. They can handle the BRRRR, the 1031, mixed use, commercial, whatever it takes, so you can close on time. Mentor of mine, guy who I really respect, Kirk Duckwall, says working with Network Title is kind of like having another personal assistant. That's how on the ball these people are. Network Title, complex deals made simple. Link in the show notes. One of the hardest parts of investing is finding a solid property manager. I've worked with plenty over the years, some are better than others. Earlier this year, I did a 10-unit deal where John and his team at RPM Viking handled the management for our mutual out-of-state client. They were professional, they were responsive, they delivered exactly as promised. Now they are my #1 management referral, and I'm proud to have them supporting the show. Learn more at rpmviking.com. Use the code TCREI300 for $300 off maintenance services when you sign up with RPM Viking as your property manager. Thanks for sponsoring the show.
It's kind of interesting if if someone actually relocates, where they relocate is kind of interesting. What's the thought process,
Yeah, my grandparents had like a summer home down there, so it was like very easy to just go. And then my mom wanted to like pivot careers, get into teaching. And back in the day, Minnesota had a 4-year degree to become a teacher, but Florida had a 2-year degree. So you could, get it quicker. But it was just, we lived in a town of 400 people, and it was still a sundown town, which blew my mind. If you've ever...
Does that mean when the sun goes down, the town shuts down?
No, when the sun goes down, African Americans aren't allowed to walk outside.
Oh.
Wow. Wait, I'm sorry. Where was this? In Florida?
In like rural Florida in the Panhandle, right next to Alabama.
What?
Yeah, crazy. Like
what year was this?
Yeah, are you
1963?
No. I mean, like this was when I was in 5th grade. So, like, man, I must have been 12. So it was 16 years ago. So like 2007. So
That's insane.
yeah,
Disturbing.
It really blew my mind. Got bullied for playing football with African Americans at recess. I was like, where the fuck do I live?
Like white kids would bully you for hanging out with them?
For hanging out with black kids. Yeah,
that's what I mean. Wow.
Yep. Went to a private Catholic school too. It was a great time.
And that lasted 6 months?
6 weeks.
Oh, 6 weeks.
Yeah, my mom had
See you
realized that
later.
it was a mistake.
Well, what's up? We're here with James. How do I pronounce your last name?
Faillettaz.
Faillettaz.
Yeah.
I would have said it different. We went to school. I went to a private Catholic school as well, and we went to school with a Faillettaz, and I thought that was something closer to that.
Yeah, the L's and the C, like the L's and the Z are silent. It's from the French part of Switzerland.
Okay, let's hear it one more time.
Faillettaz.
Faillettaz.
There was once an exchange student from the Netherlands, and she was like, "Oh, it's kind of like you're saying fighter in a Dutch accent, Faillettaz." And I was like, "Oh, yeah."
Yeah, I'm going to type it in.
That's
How do I do that? Faillettaz.
Yeah.
Got it. Well, what's up, man? You ran into Tim at the riverboat cruise, and is that why we're all here today?
Well, that was the reintroduction, but we've known each other for years. I don't even know how.
Yeah.
Oh, that's
exactly.
right. Yep.
7, 8 years. I don't know. When did you start in real estate? I guess that might be.
Yeah.
It
So
was somewhere around your beginnings, right?
Yep. So, I mean, I had this strong conviction that basically I was a junior in college. I had house hacked a triplex with my mom, painted the whole thing before it closed so we could get our FHA loan, and didn't really know what we were doing, but ended up putting like $8,000 down, East St. Paul triplex, and Mom and I lived there for a little bit. Then I went back to school. I had, the dreams of getting another duplex before I graduated, and was like, I'm either going to start a real estate company with my 5 units in a spreadsheet, or I'm going to move to Ethiopia with this Fulbright scholarship and do international economic development research there with a professor at Addis. I didn't get the Fulbright. I think maybe it was because I was kind of trying to study how communism was a little bit of a good thing and helped Ethiopia develop, and it was Trump's first presidency, and they're like, you want to study communism? Not exactly, but that's my joke. So they turned me down and moved in with my mom after college, and I was like, I'm not going to take a job, and I'm just going to raise capital. And then I started in the last maybe 4 months of my senior year of college, religiously looking on Bigger Pockets and kind of figuring out what the heck I was going to do. And Tim was pretty vocal and all over the website. So I had reached out and we had set up a meeting and kind of got a tenant landlord law book from you way back in the day, and read the whole thing cover to cover and just kind of kept up from there.
Yeah.
Cool. And now you do a lot of stuff.
Yeah.
We've had a little bit of a evolution from there.
Yeah, tell us about it.
Let's go through it. Yeah,
let's start towards the beginning. We don't have to go to the triplex per se, because let's talk about the stuff you've done since college.
Yep. So June of 2019, I had graduated. I'm living in a duplex with my mom. I have these 5 units in a spreadsheet, and I'm going to sell a part of my company. Like, my background was kind of in investment banking and private equity in the first couple of years of college. So I took that approach and thought I was a lot smarter than I was, and started to try and, I had this business plan of creating multiple operational companies to support the buying and the rebuilding and the property management. So I started selling equity in the holding company for at multipliers. So we had 5 units in a spreadsheet, and I sold 25% of the company, the company, which was 5 units in a spreadsheet, for $350,000 because of this growth trajectory. And then sold another chunk of equity a couple of years later, and then got up to about...
Real quick, so sorry.
Yeah.
5 units on a spreadsheet, that means physically a triplex and a duplex.
Physically a triplex and a duplex,
okay.
And then a spreadsheet talking about how I was going to buy,
And you're letting people know, yeah, I mean, the triplex and the duplex might just be worth $800 together, but because I'm growing, someone can buy into this company, and if you end up with a 1,200 units someday, then, man, that's super interesting. Do you have any more comments about the thought process around that, or the conversations, or the legality?
Yeah, I mean, it came from I've been in stocks off and on from an early age, and then kind of gotten into more of that private company, investment banking, educational route. So this was kind of the framework that I had. I think I was naive when I was doing it because I didn't set up dilution clauses. I didn't really we got a lawyer, and we did kind of all of the selling of shares and all of that correctly, but we didn't plan for 15, 20 years in the future. And I can kind of get into that, but we did end up totally restructuring that. But long story short, it was, the basis was, these have been my investments. This is how much I've spent on them. This is the kind of the growth. We were using the classic BRRRR model, and rates were really cheap. I was able to snap stuff up in East St. Paul. And we were growing at 50 to 60% a year.
So you add 2 units year 1, 3 units year 2, that kind of thing?
So had 5 year 1 with that injection of capital. We got up to 16.
And what was the valuation at the 5 units? You said you sold what percentage for $350?
25% of the holding company.
So $1.4 million valuation on 5 units. And how did you calculate? Because I feel like that's almost it's not enough if you're going to buy a bunch of real estate, right? And then does this entity have to sustain itself? You have to refi within the entity?
Yeah. So that's kind of where we messed up. And the strategy was to continue diluting, selling off equity, and...
What does diluting mean in this context?
So say me and investor A own 75 shares and 25 shares.
Okay.
Yep.
Investor B came along and he contributed, and then we just added 10 shares on top of our 100 shares. So now there's 110 shares, and he owns 10 of them. So diluting, it's printing more money, almost printing more stock. So I was diluted.
A little bit like a stock split in a way. That's not exactly what it is, but something like that.
Yeah, adding more kind of money to the money supply, or adding more stock to the kind of overall stock supply. So all of the stock is worth less, but because of the injection of capital, everyone's stock is actually worth more.
Got
kind
it.
of thing.
Okay. Sorry, I cut you off. I just didn't understand some of the fundamentals here.
Yeah,
Go
no
on.
worries.
So you're growing at 30 to 40%. And what does that mean? What kind of deals are you buying? And
So
where are you finding them?
we started off just buying like your classic 2 to 4 unit. In the beginning, we were using DSCR loans and we were finishing square footage. So we were finishing basements, we were finishing attics, we were adding bedrooms to like really do an equity add, but also do like a rent increase. So we would put down $50,000 to $60,000. We would get a construction loan from a bank. We would finish an attic and split a den into a bedroom, and we would add, back when we were doing this, because appreciation was doing pretty well too.
And rates were low.
Money was cheap. The construction loan was cheap.
I'm sorry, what year approximately?
So this is like from 2019 to basically 2021,
Okay.
roughly. We were doing like full return on equity and then just keeping it in and then using the cash that we had gotten from the investors to go out and buy more. But kind of, we were getting ahead of our skis because I want to say like 2022 is kind of when the buck stopped a little bit. And we had built a property management company. We had built a construction company. We had taken kind of the investment company and pulled it out of the property management company. So we had 3 companies, Revolution Renting, Revolution Construction, and Revolution Investing, that were owned by kind of our holdco, which was called Veris Paradigm Holding. And that's what myself and the investors owned. So now they owned 3 operational companies. We had about 32 units at this point, but I think we had like 11 employees and 32 units. And
That's a lot of employees for 32 units. Yeah.
yeah. And
If that's your only revenue source, you could sell other services, right? But
yeah, but we weren't doing any third-party construction. We weren't doing any third-party management. We weren't doing any third-party asset management.
So what were 11 people doing all day?
A lot
probably
of
mostly construction, right?
A lot of construction.
Little handyman stuff.
Yeah. And then like I had kind of, because I thought I was going to continue to sell equity, and I was really trying to like big brain the overall financial and like legal scheme of this. So I think I had like put on this CEO hat too early and like gotten people to do all the property management, gotten a construction manager, had like a full construction crew, had a bookkeeper. So I had built out all these companies, but then it was like what really kind of rocked me was our biggest deal, and it was set to be quite, lucrative. We bought this 5-unit property for like $400,000. We had gotten $160,000 construction loan.
What part of town?
East St. Paul.
You're staying around the east side for most of these deals?
So everything was in one zip code to like operationalize the property management and construction.
I like
106?
Yep. 55106. And we were basically with the construction loan and the purchase price, we were going to be all into this building at roughly like 580. But then with a completely refinished basement, 5 units, they all were going to be 3-bedroom, 1-bathroom, in-unit laundry, the whole thing. We had gotten a ARV appraisal at 1.1 million, which technically I think is a little high, but like our cash flow numbers were so strong too, because we were getting really high rents in these units because we were doing a Section 8 play. And then I kind of...
Real quick, what's an east side 3-bed rent for on Section 8 in 2022?
I would say like in 2022, it was probably like 1945 roughly.
Sounds correct.
Yeah. But then we had run into the construction was over what we had the capacity of doing. So we had,
Because it was commercial or just too much at once?
Because it was like pulling large permits, moving structural beams, digging footings in a basement. Like we were kind of there was about 2,500 like unfinished square feet in this basement. And we were going to completely remodel it and add 6 bedrooms and 3 bathrooms and 2 flights of stairs.
And you're going to underpin the foundation and like lower the floor.
The clearance height was actually good. Okay. So we didn't need to like dig down, but we needed to put more structural footings to just satisfy city code.
Sure.
God, that's annoying.
Yeah.
Because you weren't adding any weight above anything.
Mm-mm.
They just said these footings are no good.
Yeah, the city was a little bit of a stickler. I mean, they were even trying to get us to run full sprinkler systems because we were adding so much square footage, and I was like, we're not going to add a full sprinkler system to a 5-unit.
Yeah.
That sounds...
Tim
that
getting to
sounds
preach
regular.
here again. This is exactly why housing costs what it costs.
Yeah. But you have to admit, adding sprinklers is something that is not surprising, but the city being like, you need new footings? That's insane. But go on.
So, long story short, we found this, bargain of a contractor. He sent us all of his licenses, everything like that, and everything was fake. He had forged his contractor license.
Really?
He had put
even that was fake.
He had put his number down, like that was really close to the number of the city, and we had called it, and someone picked up and had a conversation. Like it was a pretty legit job.
Con artist. Was he even a contractor?
He was a loose contractor, but like
quite loose, you might say.
Yeah,
he owned a hammer.
I mean, he'd done work, but like we'd even gone to a job site, a Paul Davis job site, that like he said he was like subbing it out to his uncle, and he walked us through the whole thing, and like he had no business being there. Like
he wasn't related to the project even?
He didn't have anything to do with the project. But he had walked us in, he had showed us what he was doing. Like it was a fairly elaborate scheme.
Yeah, he's done this before.
Yeah.
Where did you find the guy?
Oh, that's a good question.
Facebook group?
No, I think it was like a light referral from somebody. Actually, it was like someone that we had used to do egress windows for us gave us this guy's contact for his uncle, and then his uncle said, "Hey, this guy Caesar might be able to do some work for you. He's done, larger projects," which he had done some larger projects.
Okay.
But I think he saw like how I had kind of pulled back. We had a construction manager. Things were a little loose. And basically he was like, I can remodel this whole basement for you for like $80K and all the permits.
2,500 square feet. That's,
yeah. And it was like, okay. And then just time after time, we kind of got played more and more, learned some really good lessons here, but we basically ended up having like, I think it was around $70,000 stolen from us. Default judgment, we won, but he doesn't have any money.
Yeah.
He had spent it. Yeah. So
how did he get 70,000?
What are some of the lessons? I mean, I think it's good for people to hear this. And by the way, thank you for being honest and being open about it. Can you share like some of these warning signs? I want people to hear them as you can remember them,
Yeah.
So they hopefully don't end up in this situation.
Yeah. So I think, me being a little bit removed and us being like, me feeling like we had a deadline and like, well, I think the number one, and it's a little cliche, but it's like, if the deal is too good to be true, it probably is.
Okay. There you go. Yeah.
Like,
I like that one. It's good.
Yeah,
worth
it's a little
repeating.
cliche, but it's true and tested, but it's true. And then I think we had a lack of understanding about the complexity of it all. And, legit contractors, they're like, hey, I want 30% down, I want 50% down. But he's like, hey, I need to pull all these permits and hire like subcontractors to do footings and HVAC and this and that. And I need to put down payments to them. So I need a larger down payment from you. So it was like there was a lot of money given up front. Mm-hmm. And then I'm kind of forgetting some of the details, but then we had reached a point, he had done some work. So he had started digging the footings. He had started, getting subs together. But then he was like, so-and-so needs more money. So-and-so needs more money. And it was the slow bleed where it was like half down.
Yeah.
And then this hang up happened, this hang up happened, this hang up happened. And I think it was like 5 or 6 payments. And like, I look back and I'm like, yeah, I'm an idiot. But, at the time I'm probably like 23 years old and I'm like, we're going to make $400,000 on this deal. Like, it has to be real. Like, I'm kind of like hoping and praying that this is real because of the upside.
Yeah.
And I was kind of
I've been
tantalized
there.
by
I totally
the
can
upside.
understand how that happens. Yeah.
Yeah.
Totally have been there.
So
I guess I've never done anything on a super large scale for contractors, but pay for materials, right? But you don't pay any labor until the labor's done, right, Tim?
Typically, yeah. I mean, it depends on the size of the project.
Some
and
draws,
stuff.
yeah.
Yeah. It does depend on the size of the project and how much I've dealt with the contractor, and there's some factors, But yeah, typically not more than 50%, right?
Yeah.
That's kind of the cutoff, unless there's a legit, like, here's how much all the materials are. I'm buying them. I'll buy them from Home Depot and have them shipped there.
Yep.
Then I might even give them a little something, like a couple weeks, like, okay. But yeah, usually there's some work done, right? Like, okay, you need to pay your workers. I'll give you X amount on Friday, that kind of thing.
yeah, and I think one of the biggest things was like, this was like the biggest job, the biggest kind of project we had done in company history. And like, I had kind of given the responsibility to a construction manager. And like, I'm not blaming him for it, but like, I was somewhere else with my CEO hat on, trying to be like, okay, once this project is finished, like kind of borrowing from the future, like already thinking that it was going to be done. It's like, okay, once this is finished, like this is going to be the market capitalization rate of all the companies. Like, this is how I'm potentially going to sell my next chunk of equity to an investor. And like, this is how we're going to take the next leap. So I'm like taking my eyes off of what's truly going on and like the operational side of like getting it done and focusing on growth, which, I just think we weren't ready for at the time.
Great to know.
Yeah.
Okay. So,
Well, how did that end?
fast forward. Yeah. Let's get to
So, I mean, we were able to salvage it. So, we did have our own kind of construction crews, and we had done some of the cosmetic work in some of the other units. We basically decided once we like got to a point where we knew that this wasn't going to end when it well anymore. So we decided that we went back to the bank and we had a super open and honest conversation and like told them what happened. And we said, we're going to scrap the whole basement remodel and we're just going to finish 2 more of the units on the first floor that were not renovated because we were kind of opening them up and sending staircases downstairs. So we had finished the 2 top units. We had made them both like from a 2-bedroom den into a 3-bedroom, kind of fully cosmetically remodeled them. So we had spent some of the construction funds on good things so far. And that was internally like our crew. So then basically myself and my construction manager kind of just put on our hard hats. I started looking on Facebook Marketplace. We were painting the interior units. We were pulling I was driving out to Wayzata to pick up a vanity from like somebody off of Facebook Marketplace to like save costs anywhere we could. And the bank ended up giving us like $15,000 extra dollars, which was, they didn't need to do that in the construction loan, which was very appreciated from them. And we were able to finish the project, and we still got it appraised for roughly like $750,000 without the basement being done. So we had roughly, if we're not including like our time spent on it, construction dollars and purchase price, we had still come up with like $80,000 in equity. So we didn't lose money on the deal.
And did it cash flow?
Beautifully.
Okay.
I mean, and this is...
So in some ways, what's the problem other than you didn't get 300,000 more?
I mean, it was a great lesson
Or
learned.
400,000 more,
And
whatever it
like
was.
the opportunity cost,
Yeah.
we really lost a lot. And we probably added an extra $100,000 of debt that like just didn't need to be there at all.
Sure.
But luckily the debt was at 3.75%.
Yeah.
So that doesn't hurt. And then, yeah, I mean, this is we were able to turn a couple of the downstairs units into 2 bedrooms. And I mean, this place today, I think there's a $4,000 mortgage and it cash flows like revenue wise, it's like $11,000 a month. So like,
there you go.
yeah.
Right?
So like the project still worked, but like it was a real, so this was, I think, this like tipping point for me was like, okay, big mistakes can happen. I got over my skis and there's too much responsibility for other people that like don't have the ownership and like aren't like truthfully invested and are never going to love it as much as I am because of like how much skin that I have in the game. So like I took a really long, hard look. I was like, I'm just having to scale stuff back. And we went from like 11 employees to like 4. And I had some really hard conversations and it was like, we're keeping 1 property manager, 1 bookkeeper and me. And like, then I started to kind of look in the mirror being like, if I have these limited partners that own the operational companies, but don't have any operational oversight, like I'm kind of, and if I have to sell my equity value to raise more capital, I'm kind of like in perpetuity, just like working for
them?
these guys.
Yeah.
Forever and ever in real estate. And I talked to, a couple people. I had joined a mastermind at this group or at this stage. And a mentor of mine was like, you've done really well and this is really interesting, but everything is wrong. And you either need to sell everything or like completely restructure. And over the next 14 months, we had, me and the investors had some pretty tough conversations. I dropped my equity from like 69% to 20% of the assets, but I got all of the operational companies, all the ownership in the operational companies. And we packaged all the 32 assets we had into a fund. And I kind of like generously gave equity back to the investors because I was like, you guys took a big risk, you kind of had this allure, but like this for where we're at right now, this is just not going to work. Like we can't like continue to sell equity in the holding company because I'm just kind of like tied to you guys indefinitely. And because of the equity splits that they bought in on, like the second round of capital that we raised, he was still at about like half of the equity that he put in, maybe like 2/3.
What do you mean? What do you mean by that?
So
meaning he put in X and
so like, let's say the whole thing was worth $1.3 million. And it's a little hard to do like enterprise value of the operational companies.
Sure.
But intangibly, like all the assets without the enterprise value was worth like 1.3 or something like that.
Very good. Yep.
And he bought in more or less on like a 3x equity multiplier. So every dollar he gave me was worth 33 cents of equity because we were, historically growing
and he
at
had gotten
40,
up to 50% is
50%.
what you're saying.
Probably about 65.
Okay, got it. So he was negative.
He was negative in terms of like the dollars he put in to what his current equity value is.
Fair enough.
But had grown 40% the last year, like something like that. So,
yeah.
And I don't have all the stats right off the top of my head.
Yeah. I just want to make sure I understood what you meant. Yep.
Yeah. So I was like, I can continue to keep selling my equity in the holdco and raising capital or like going and starting a fund or like doing hard money lending and taking down projects and growing equity. But it's like, that's not like, I'm not a startup. I'm not like reinventing the wheel. We're not doing third-party property management. We're not doing construction. Like, we're not really like a service-based business at all. So I gotten a little over my skis on the kind of complexity of company structure at first. But it really gave me a good learning experience, and I was able to give a lot of that money back to the investors. I still kept, roughly 20% of the fund. So I had still made some equity in the 32 properties. And now I had 3 companies that had contracts with the fund, were stable, and I could kind of grow from there.
Okay.
And that was kind of the next phase of business.
And this all happened, like, when did the restructure, let's say, complete for?
Yeah. So it was a 14-month process because things were slow, and we really needed to we got lawyers involved, and we had to rewrite all the operating agreements. Mm-hmm. And timelines are a little fuzzy, but I would say, late 2022 was when we kind of started the restructuring project.
Okay.
And 14 months later, so mid 2024.
Okay.
Was when we kind of.
So about a year and a half ago is when it was completed. Okay.
So.
And did much happen in that? So in that 14-month period, did you guys keep growing the company, or did it stay pretty?
No. So because if I wanted to keep buying stuff, we didn't actually restructure yet. So I was I can't really, we had a really good operational kind of optimization, you could say. We had really, really low vacancy, and we had really, really high collections, and we got our maintenance and repair in check. And at least the 32 units were just spitting out cash. So it was I can go to them and I modeled a couple years in the future as well and be this portfolio is worth about X. I'm going to return, a large amount of ownership to you guys. It doesn't make sense for you guys to own operational stake in the kind of operational companies. But you guys are going to get a lot of the asset value back. But
and consequently, the cash flow too that comes along with that, right?
Exactly. And the depreciation.
Yeah.
Because these guys, high earners, they have other stuff going on. They didn't mind getting those K1s with losses and kind of getting that free cash flow. So,
can you give us a few examples of how you connected with one of these investors and what the dollar amount was that they invested at first?
They were both classmates of mine.
Okay.
And, they were both, without kind of spreading too many people's business, mm-hmm. They were both 6-figure investments plus. And it, I was kind of very eager and really sold the dream of owning a part of this startup. But then we figured out that wasn't going to be able to happen.
And would it have been, you're almost too smart for your own good in this story, because real estate is some of the best real estate investors are kind of caveman, buy house, make house better. And
buy house.
If you would have gotten, dude, I don't mean to, dude, I could never do anything close to what you've done here. So I'm not trying to rag on you, but if you could have just gotten a loan from someone and been I'll pay you 11% interest, and then all of this shit's yours. Yeah.
And I have a knack for over-engineering things, as you might be able to imagine. And I'm a math guy, and I love kind of when I was selling equity, I had 7-year projections for what we were going to do with the property management company, what we were going to do with the investment company, how rates were going to reset. I had these very complex Excel models, and was basically really able to back up a lot of what I was saying, at least financially. But operationally, things can be a little difficult sometimes, and you're going to run into hiccups. And mm-hmm. then when the rubber hit the road, I think the biggest thing for me was even if we continue to grow at 50 to 60%, I'm going to need to work the way that I'm working and sell 30x% more of my equity to just get them a reasonable return, get the investors a reasonable return. And it's just like this, we set it up wrong, and we had the good intentions, and like, you know, there was high growth potential, but we had just kind of set it up wrong, and I had started to overgrow. So
overgrow operations without profit, correct?
Yeah. And like, I'll be the first to say it, like I'm okay at operations, but like what I'm really best at is like selling a dream, doing the numbers, like being kind of a charismatic face. And like today I'm able to do more of that, which I really enjoy because we have really good operational people in these roles now. But back then, you know, this was the first business that I had ever built. I'm 23 years old. I'm like, I don't really know how to staff. I don't really know how to like vet people. Yeah. So we were just running into operational problems.
Yeah, that's awesome. So we get to the end, everything's restructured. You haven't really, you're just kind of maintaining, and then the split happens, so to speak, not split because you're still with these people, right? But like the operational split happens, or the equity split, however you want to call it. Now take it from there.
Yeah. So, I mean, there's one thing that when we decided we were restructuring, to show good faith, I cut my salary from the kind of companies. So we were paying very minimal amounts for like a property manager, a bookkeeper, and one kind of quasi maintenance person. And that's kind of what the fund could support. It couldn't really support a CEO. Sure.
It almost never can, right?
Yeah. You have to get fairly big.
350 units, maybe.
Yeah.
Maybe, right?
Exactly.
Yeah.
So I was like, how the heck am I going to make money? So I had looked at like, should we do third-party property management? You know, should we do third-party construction? And I'm like, operationally, like these aren't things that I should probably take on. But I was at a lunch with the agent who had sold me the 13 buildings in my portfolio, and she gets a call, and I looked at her phone and it said Zillow, and I was like, Zillow is calling you? And she was like, no, it's a Zillow lead. I'm like, what's a Zillow lead? And she was like, well, I pay for Zillow leads, and like this person just tried to call me and they wanted to set up a showing for this house on Summit. And I'm like, oh, why didn't you pick it up? She was like, oh, I'm so busy. You know, this is kind of the height of like the agent market. And I'm like, well, if I got my license, could I pick those up and I'd give you a referral fee? And she was like, yeah, that's fine with me. We had built a really good relationship. So during the restructuring process, I get my real estate agent license, and I'm starting to take some of her kind of overflow Zillow leads. And it was like I was blown away. Let's just put it like that. I mean,
because you've been doing all of these like lower dollar per hour tasks, and you're a visionary, you're a salesperson, but you're worrying about like fixing toilets for $6, and then you get that commission check, and you're like, what?
I do think you're the first person to ever say you were blown away in a good way by Zillow leads, though.
I mean, well, I wasn't paying for them, so that's one thing.
Right.
But the second thing is like, you know, she had been in business for so many years. She's had a great like real estate career so far. She's still doing a really good job. And so she had a bunch of referral, like repeat clients, and she would take a Zillow lead every once in a while, but she was incredibly busy. So I remember the first Zillow lead I took, it was for a house on Summit, and went there, showed it. Like I was just kind of faking it until I made it. Like, you know, I had never.
What year is this, real quick? Just a couple years ago, right?
Gosh, it must have been 23 or
23,
something.
Okay. Like mid 23, and I had a really good understanding of like the fundamentals of the housing market. So
absolutely. At this point,
I knew how, you know, construction worked, financing. Like I was able to talk a lot about it.
Probably better than 90% of agents. I was just saying, honestly.
I mean, especially the part-timers who like work at Target corporate and sell, you know, a friend or a relative a house like a couple times a year.
Yeah, and she's amazing with the contract stuff. So she would help me write the contracts. But long story short, I did one showing. 2 days later, I did a second showing. And 4 days later, after initially meeting, we write an offer, a full-priced, almost cash offer
On Summit?
an $800,000 house on Summit.
Yeah.
And it closes 35 days later, and I get my chunk of the commission check, and I'm like, what? Like, is this real? So I had like this like light bulb had kind of clicked that like there's money to be made in the agent business. So I think during the restructuring process, we like my first year as an agent, just putting my name out there as an agent to all the people that I'd worked with in the past and taking these Zillow leads, I think I did 24 transactions.
24 is a good number.
Yeah.
Oh, all right. I mean, yeah.
And it was
Good
just
life,
like, oh, there's something here. So I completely like subsidized my income, was fine not taking any salary or any money from the fund. So I was really able to kind of give that back to the investors full-heartedly. Was able to
Which you still own part of the fund, right? So technically you got some income out of it. But
I did.
But not enough to live on, probably.
No, not enough to live on. And so, fast forward, we're maybe like a couple months away from signing on the dotted line for the restructuring. And I had met my now director of operations playing basketball at Lifetime. And he was incredibly interested in real estate. He was working like a pretty high-end sales job, really salesy personality. And just on nights and weekends, he would come into the office and we would kind of like play around with real estate. And then I finally convinced him to quit his job and come be my director of operations for my agent business that like basically didn't exist. Again, I'm like selling this dream. I'm being charismatic. I'm like kind of thinking of the vision. But it really worked out because he's incredibly efficient and operationally minded. And now, and I can kind of tell how we got there, but now we have, I think, 5 agents and a fully fledged real estate agent business. And we'll probably do with commercial leasing, we'll probably do 50, 60 transactions in 2025 this year.
Nice.
And that's been kind of one of the ways that we've been able to subsidize and pour money and buy new stuff like we have in the past, year and a half.
All right. And so now you own the individual operational companies, the property management, is one of them an acquisitions company then?
So it's
the
Revolution
construction?
Renting,
Yep.
Revolution Construction, Revolution Investing, and now Revolution Realty, which we added on.
Which one's your least favorite?
Well, full disclosure, Revolution Construction is probably closing. We're just getting out of the game. We've absorbed kind of our heavy-hitting construction people into our property management company. But if we're going to do like large-scale remodels, like we're good at turns, we can do that. But it's just operationally, you need a certain level of like commitment and like really paying attention to the details to run good construction projects. And like, it's either I have to put myself in that seat or I have to hire somebody really expensive to do that. And we're just going to get rid of the construction company and it's going to be absorbed by the property management company.
You got to have deal flow, right? You've got to have backup, and they got to be profitable deals, like,
Yep.
right? They can't just be.
You got to keep
working
your guys
with
busy.
Yeah. You can't be just working with investors on, unprofitable deals, and
Yeah.
Okay, well, sorry, kind of interrupted.
Can you tell us about, like, I'm curious to see, like, an average day in your life. Are you very organized? Like, do you have an admin who, like, puts a calendar together for you?
So, I mean, and I guess maybe just backing up a little bit.
Oh, sure, yeah.
So we, like, I'm trying to, like, piece all the timelines together. So yeah, I guess I'll talk about the day in the life, and then we can kind of backfill from there. So I use Trello, if you've ever heard of that.
Yeah, it's like it's kind of like
It's kind of like Asana.
management software. Yeah.
It's like a, workflow. It's like Monday.com, Asana, something like that. A little bit more customizable. And then I use Google Calendar pretty religiously, and then like some Google Sheets. We're in the kind of like Google ecosystem. And I have time blocks on my calendar today that are like, high level meeting with director of property management, like high level meeting with director of real estate agent business and real estate admin to talk about transactions that we have going. Financial meeting with bookkeeper, financial meeting with like financial controller. And it's like, those are splotches on my calendar. And then just like reviewing the financials, going through our CRM Lofty, following up with all my real estate leads, and then just like underwriting time. So time for me to go into my sheets, look at all the properties, underwrite them, do kind of my own asset management. And that's day to day, week to week. That's kind of what stuff looks like for me.
I want to ask him so many nosy personal
yeah.
questions that are not appropriate for a podcast.
I got one. How many properties do you underwrite in a month? Let's say, like, let's not break.
Yeah. So we're not, we can kind of back into this, but we're not doing any acquisitions right now.
Okay.
Because from when we signed on the dotted line for the restructuring, again, over-engineer things, probably make things too complicated. But within the last 14 months, we've bought 101 units on kind of master lease with purchase options, zero money down, takeover strategies.
Yeah.
Okay, we got to talk about that.
Yeah.
And then we bought a property management company to help support that as well, which was a big mistake. But
To buy the company, or you should have created it, or you should have done
no,
neither?
we shouldn't have bought it.
Done neither then?
I love buying the units, but buying the property management company was a little hasty. We had these two deals that we were buying, a 33 unit with about 26,000 square feet of commercial space, and then a 36 unit, like really large building, all 2 and 3 beds. And this property management company was managing these two buildings.
Wait, you're buying
Okay, so they
these-
were associated with the buildings
Yeah.
themselves.
But wait. You're buying these buildings, or you're putting it on a master lease at this time?
So I say buying, but like technically we're master leasing with purchase options.
Got it, okay.
So I know we're jumping all over the place.
No,
but
we're following you. You're good.
So we signed on the dotted line, and
Wait, I'm so sorry. You signed on the master lease, or you signed
so-
to buy the property management contracts?
going farther back than that. So we signed to restructure
Got it. Sorry.
so now it's like I own the operational companies. We'd given the equity back to the fund. I have some cash producing real estate activities that I do. So I have a little bit of cash of my own. So I'm like, okay, I'm going to go buy something now. I'm going to go do it how it's supposed to be done. I'm going to create like a carried interest model. I'm going to find investors. We're going to do like an 8 pref with a GP LP split after that. So I had found these two investors.
You didn't use the same investors from before?
No.
That relationship had deteriorated, I take it?
We're still good friends. Like I had a call with one of them actually on the way here.
Okay,
like
yeah.
we're, it's a little tense sometimes, but like I think I'm doing my best to really honor them and like respect the opportunity that they gave me and like give them the return that they deserve.
Got it.
But we're also trying to make sure that we're setting things up correct in the future.
Got it.
So
I suspect they're going to do just great.
Yeah, I'm not
real
worried
estate's a
about
long-term play. If they own a fairly significant portion of 32 units,
yeah.
yeah, it's
And-
good. They're going to have it's going to be worth 5, 6, 7 million.
Yeah.
if not more.
And
right?
it's like we have cheap debt. Everything we did a portfolio refinance when we restructured kind of serendipitously.
Yeah.
So everything of those 32 units is on 3.75 debt, and like our principal payments every month, they're pretty good. So that one we kind of got lucky on. But
Okay. Anyway, go back. Sorry.
so I'm at a kind of a national conference for this mastermind group that I had joined called GoBundance.
Yeah, I know GoBundance.
And I met these two guys out of LA, and I kind of told them my story, and I was like, I found this really good 18 unit building. This is kind of we're going to go in, we're going to do light renovations, and we're going to like rent these units out for more. This is the full underwriting. And they're like, hey, this looks pretty good. Like, we'll do this. So we get the building under contract. And admittedly, like, I hadn't actually bought something this big ever. So I like kind of knew what I was doing, but I kind of didn't. And like, I got the insurance a little bit too late, and they had kind of seen like, okay, you're really smart and like you kind of can sell the dream, but like operationally, can you do this?
The lender's saying this?
No, the investors.
Got it.
So at the 11th hour, basically the investors were like, hey, you know, they're big into mobile home parks. They own a bunch of mobile home parks around the country. And they were like, hey, we don't think we should buy this anymore. We had gotten the inspection. We had put down earnest money. We had written legal docs. And they're like, hey, we'll pay for the legal docs. We'll pay for the inspection. But like, we got to be out because we just want to make sure that like we're kind of investing in stuff that we know. And like, I talked to them recently at an event, and they're like, truthfully, it was because we didn't trust you. But, you know,
nice to hear after the fact. Like,
yeah.
Now you know, right?
Yeah, and like, you know, I think one of the biggest things is like I try not to like take things personally and like really maintain good relations with people, because you never know what's going to happen. And like, I think it's paid dividends with the investors I have in the fund. And like these guys, again, I met them recently, and we were able to have good conversations, and I'm not taking this personally.
Yeah.
But I had gotten to know the seller of the building, and I kind of showed him my underwriting for the building a little bit. And he was like, do you really think you could do this? And I was like, yeah, totally. I can definitely do this all day long. We own the property management company. We can, you know, take this down. It's not going to be a problem. So he was like, okay, what if we were able to come up with like some creative financing structure? Because I had been honest with him. I had said, hey, the investors backed out on another building that I own. So we got this opportunity on a 17-unit building in the east side to kind of, you know, and I was over-engineering things again. I was like, okay, I'm going to turn one unit, and then I'm going to get 2.6% equity in the building, and for every unit I turn, and it was just this elaborate scheme. And I talked to a couple of guys in the mastermind. They're like, I mean, it's interesting, but like,
Why?
Why? So go talk to a lawyer. Yeah. And like, I talked to this lawyer named Lindsay Hobbs, who's great. She's a contract lawyer out of Tennessee who like does big work.
I know her well.
Shout out Lindsay Hobbs.
I've paid Lindsay Hobbs $50,000 in my life. Yeah, something like that. Yeah, maybe more. I know her well. Yeah. Did you meet her through Eli?
No, I met her through a couple guys in my Abundance.
Oh, okay.
Yeah. So basically, she was like, you know, this is great, but like this is crazy. Why don't you just do a master lease with purchase options? We can write it up. It's basically the same thing. You're still getting, you know, the strike price. You still have full control of property management and construction. So we had set up this first one where it's like, we agreed on with the owner of the group, we agreed on what the price of the building is in its current state. And it was fairly dilapidated. So we had kind of come to that agreement. We knew how much debt they had on it, so we could kind of back into their perceived equity. Okay. So what I did to provide value to those, like to that ownership group and those investors, was like, one thing right off the bat is when I transact on this property, I'm going to waive my agent fee. So you guys are saving, you know, they were pretty highly leveraged on the property. Let's say it's a 4% agent fee, you know, rough numbers. If the building's worth $1 million and we're charging a 4% agent fee, that's
$40,000.
$40,000. Thanks.
Yeah.
So that's like, you know, from the equity that they have, I mean, that's like roughly a 12% gain just by waiving the agent fee. Yeah. And then I'm saying, I will give you a 30% return on your equity over 2 years plus waiving of my agent fee. But the debt is factored in. So me making the principal pay down is doing about 60% of the work.
How do you guarantee a 30% return on the equity? How does that work?
So let's just say that the strike price for the building is $1 million.
Yep.
And then in 2 years from now, the strike price would have to be 1.3. But the debt is going down consistently. So the equity, I'm kind of benefiting from the principal pay down, and they have really cheap debt on the building. It's 2.9. So like just my...
And what's and shorter amortization too? Like 25-year, 20?
20-year AM.
Yeah.
So just me doing the principal pay down is doing like 60% of the work of giving them that return because they're fairly highly leveraged. They don't have that much equity in the building. And the strike price was about 77 a unit. And in March of 2026, it's going to be about 81 a unit. These are rough numbers.
Yeah.
But then I go in and with my agent income that I've made, I go in and renovate every single unit and rent them out at Section 8 payment standards. And when I took over this building, it had a 0 NOI. Like it's making no money. And today we've kind of gotten rents from roughly like $12,500 to about $25,000 a month.
Yeah.
And on a cap rate analysis, you know, at a 10 cap, this building is worth 1.7 now, 1.8, and my strike price is 1.3. So like that's kind of the strategy of how I did that. And then it was working. I was able to take operational load off this owner.
And you said it's in East St. Paul?
Yep.
Yeah.
That's super cool.
So we just started to do that over and over again. So we did it on the 17 unit, did it on a 15 unit, and now we did it on a 36 unit and a 33 unit with about 26,000 square feet of commercial as well.
But I feel like this was awesome. You started to talk about the property management company that you bought. That was a bad idea.
Yeah.
They were managing these properties, or the first one at least.
Yeah. So we had never done any third party management. And we had gotten the 17 unit, the 15 unit. We had the 32 units from the fund. So we have about 60, 70 units at this point. And we get the opportunity to basically take on this 36 unit and this 33 unit. So more or less double our portfolio size. And I'm like, I don't know if my property management company can like actually handle this.
Yeah.
So I started having conversations with the property management company who's doing it. And, you know, I think that they were doing a lot of third party. They were making a lot of money on third party management. And like my property management company was really set up to make the investors money. You know, I'm probably
almost as if that's how it should be.
Yeah, I'm probably like, you know, I'm probably seeding my property management company at this point with like $1,000 a month from agent income, just to like, I'm losing money every month on the property management company, but it's adding so much like value to the assets where I'm like, I don't care. So then I see that like this property management company is doing third party. They're making all this money on, you know, maintenance and repair and their contracts, and they have 13 employees and I can take it all over. So we go in, we buy it, and it's just...
how many do they have under contract outside of the 30-some unit? Or I'm sorry,
they have about
60.
250 units.
So you're getting all of those. It's not... You're getting the management of all of those plus the ones you're buying. Okay.
But then, you know, we basically handshake agreement, we buy it. There's a couple details that I'm just going to leave out, but like I start looking through it and it's like some of the contracts are just really bad, like really low property management fees and like more work, and like operationally we're having to use 2 different property management softwares because one of the owners wants us to use one software, and it's just like kind of a mess. So over the course of, you know, the last couple of months, I've just written that purchase off kind of at a loss. And we have 2 of the 13 employees with us still, and we've gotten rid of 75% of the contracts. And I am incredibly happy with where we're at today.
I love it. Yeah. These are the kind of things that people don't get to hear. So thank you for that again.
Yeah, and I'm a pretty open and honest guy.
Yeah.
So
no, and you have been, and this is like in some ways, this podcast is a little bit the anti-bigger pockets podcast because so many people. Even you could tell us that you acquired 100 properties over the last year and a half, and
you could have skipped a lot.
Everything is going great.
And so thanks for that because we want to be real and really truly appreciate that.
Yeah, absolutely.
It's so funny, dude. Everybody in property management's kind of trying to get out of it. It feels like, or not everybody, but.
Well, I think the reason why people do it is kind of like you're thinking, so that they can control their own because they don't generally love the third party. Yeah. But then they realize I don't have enough scale to even afford my own people. I need to take on third party just to be able to afford my, doing my own. And then you get this.
Well, you and everyone else doesn't like third party management, right? And then you're going to become the thing that no one likes.
Yeah.
That's the worst part.
And it's just because the incentives aren't aligned.
They really aren't.
That's the toughest part of doing third party property management is I make money by going and doing maintenance on your properties, and you lose money by me doing maintenance on your properties. And you can kind of try and work it out. Well, go ahead.
No, I'm sorry. Go ahead. Yeah.
I mean, I don't know. I think that it's hard to just say you're going to be some altruistic property manager and do everything right. And then when the incentive models are so disaligned from this is how this company kind of makes money and survives, and this is how this kind of company or building makes money and survives, and they're just polar opposites.
Yeah. And even you kind of alluded to it, but in big properties, not anything above 4 units, they're valued based on their net operating income, and because of that, the property manager themselves, everything they do to run the property well probably hurts NOI, right?
Yep.
And if they actually improve NOI, they get 0 from it.
Yep.
So they're not benefited by creating the most amount of value for you. They actually benefit only if they create low value for you or subtract value for you, right? So it's just tugging.
And it's I think you kind of alluded to it as well. To do property management well, you need to be at scale. You need to have people specializing in different tracks. I'm less on the geographic side of this property manager is going to own everything for these 3 properties or this kind of scattered side of properties. I'm more we're going to have someone that's running leasing, someone that's running maintenance and repair, someone that's running rent collections and documentation and things like that. But to have good people in all of those roles, you just need to have a certain number of properties.
Yeah.
And we're still to this day, because we're not at the scale we need to be, I'm still to this day subsidizing the property management company. But it's worth it because of the return that's kicking off the assets. And I can kind of do it because of the real estate agent income. Mm-hmm. And I think that you really don't get to scale until you're managing 300 somewhat stabilized units.
Yeah, because if they're not stabilized, then that takes all your time and attention. And so you're spending all this time on this one asset, and the other ones are slowly losing occupancy.
You're not getting to play defense.
Yeah.
So you're playing a bunch of offense, but then if you're not playing defense on making sure the renewals happen, making sure you're doing the preventative maintenance so, your sun scar on your face doesn't turn into cancer. Because that, it happens very fast in properties.
It does.
And if you're not playing defense, your offense is just going to get so much harder.
Yeah.
I manage properties on a very small scale. I went through the same thing a couple of years ago where I thought, I'm not happy with my property management referral partners, and I'm giving away all of this great business. So we got up to 50 units, and then I just ended up helping each client find a manager that was good for them.
Yeah.
And now I still am managing my portfolio plus 4, 2 single family homes, a triplex, a fourplex, and a duplex for other people.
Yeah.
And at an ultra small scale, But I am doing the altruistic thing, like for real. I'm not making any decisions that really make me money. I have a higher than normal monthly fee.
Yeah.
So I take 10% of gross rent and a 1 month lease up. So it might make like 36 grand a year. And then it's me and a VA that do it, you know?
Yeah.
But we both know as agents that if I put that time, hour a day, whatever it is, into lead generation, then it's 6 figures a year. And I really truly am holding on to these particular properties because I don't want to let people down, you know? It sucks, man. Like,
It's
like
really
selling
hard.
someone on something and then being like, hey, I don't want to do this thing anymore.
I made this bad choice.
I don't have it in me to do it to like certain people, but it's it's not a good feeling. You know,
No.
That's why you got to have lots of kids so they can be your property managers. That's the Tim approach. I'm almost 20 years into my into my plan.
Yeah.
A few more years and we'll be ready.
That's awesome.
Yeah, we were talking about Hinge before you got here. Any ladies out there looking to procreate a little bit more?
Well, man. So what's next for you?
Yeah, I mean, so we're doing some restructuring of our agent business. So we're kind of, we have too much work to really handle right now on the agent side of things. So we're trying to split, almost like property management, we're trying to split the agent business into different tracks. We'll have a multifamily track, we'll have a residential track, and we'll have a commercial track. And for anyone out there who's, you know, maybe selling 12 to 30 homes a year, we're looking to like put somebody like that as the team lead in our residential side, and then like really funnel all of our leads to them and add a lot of like operational and synergistic value. So that's kind of one of our big steps.
Can I ask, are you guys Zillow Flex or what's your lead?
No, it's just all referrals and a lot of synergy. I mean, so we benefited from, I had a connection with Joe Meyer and Peter Remish of First and First. They're a commercial redevelopment company. They've done projects like Lucky Shots and Vandalia Towers and the Aria, and they just bought the James J. Hill Reference Library, and they have a really cool portfolio. They actually closed on the Prior Works building, Can Wonderland Blackstack, whole 500,000 square foot building last Thursday, and we've signed an agreement with them where we're doing all of their leasing on their 2 million square feet. So we get 7 to 10 leads a day on that. And we're sending people to our website. And then people are like, oh, I'm looking for a space, but like you guys also do residential real estate, or you could also help me buy a multifamily property.
Sure.
So that's a great referral lead. And then just through property management, through kind of my network for the past 6 or 7 years in the agent business, and through circle prospecting when we list buildings, we have more leads than we can adequately handle right now.
Cool.
So we're kind of setting up those tracks in the real estate agent business, and then
who's the principal broker then? Are you a broker at this point?
No. So we office out of Keller Williams Woodbury.
Cool.
Erin Duckworth over there, if you've ever heard of her.
Yeah, definitely.
She's just a rock star. She's really helped us kind of like set up the right infrastructure that we need, play on our team, help us recruit people, and help us really grow this agent business. So we've thought about doing brokerage, but like they do such a good job.
Don't do it.
Yeah. And like, again, it's one of those things that you kind of need scale to do. And it's like, we're not trying to grow that business. And she's such a rock star player.
Well, you're both realtors, and we know we have a lot of realtor listeners. Think of how much the gross commission is on the side, just one side.
Yeah.
How much of it do you receive? Don't answer me. Is it worth it for your broker to receive the other part? And the chances are the answer is no, right? Because I know roughly what your splits are, right? The bottom line is the realtor makes all the money in the transaction and the brokerage makes zero.
Yeah.
And so they have to offer title. They have to have a couple desk fees, right? It's all fee-based stuff.
Yeah, or just have 500 agents.
Or have 500
and
agents,
benefit on the transaction fees and stuff like that.
But then you got to keep the agents. Coldwell Banker's writing checks. You got all these other models. Yeah.
We
No
talked
thanks.
to a couple people that we were recruiting recently, and they had the golden handcuffs. You basically, have to stay at this brokerage for a number of years because they got these big checks.
Yeah.
So,
Yep.
and then this is, we're kind of looking into ways that we can acquire, and, we just kind of happened into it a little bit, but because everything is master lease with purchase options, I don't actually own any of it, but I have really good strike prices on it. So my kind of next venture for 2026 is starting a real estate, like private equity fund, that we're going to seed the fund with these 101 units that we have really good strike prices on. And then
That's your option price when you keep using that term.
Yep.
Got it.
Yeah, that's kind of our option price, even though we've added a lot of value to the buildings. Our option price still stays relatively low. So
You probably have already done this, but if you haven't, have you checked with a CPA on how you need to exercise that so you don't end up? Because if you just sell them and you never take title, that's all earned income, and it's not. It's short-term earned income, not capital gains.
well, we don't own them though.
Right.
So that would be for the investors or the current owners to figure out, because it would just be, we would be buying them, but there's no income necessarily if we just seed the fund.
Yeah.
If we buy them for a relative market value, if that makes sense.
Yeah. Yeah. Well, if you buy them for the current value and you don't take the equity out. My thought was because you own it for 1.3, it's worth 1.7, right? That 400,000. Since you're not currently on title, you're not benefiting from long-term capital gains.
Yep.
Meaning that if you do try to sell them, you can't even 1031 it.
Yeah.
You're just
Yep.
you're paying 40%.
Yep. And that,
So that's why I was saying an accountant is really going to be important here to figure out okay, I need to strike on this and I need to wait at least 12 months before I even 1031 it. You've got a great problem, but it's a problem if you do it wrong. That's all.
We've looked into that. One of the ways we're thinking about it is depending on how we structure the PPM of the fund, the fund would just buy them at strike price. We're not making any of the delta.
Right.
And we're really seeding the fund with these really good deals. And we'll do it kind of European model where all of the deals blend together to have a rate.
Yeah.
And then we'll go out and we'll over raise. So we'll take a certain amount of money to buy the 4 buildings, but then we'll have another chunk of cash that we'll go out and buy,
additional properties. Yeah. I mean, again, it's probably too high level or too much of a ethereal conversation for this, but I was just this is an awesome. I mean, what you've built is wonderful. It's not a criticism. I was just saying, okay, this is if you just go off and buy these properties and even try to sell them to the fund at what you frankly have earned, you've got a major tax problem. I mean, just on that one property, it'd be at least $160,000, if not more, in taxes.
Yeah,
so,
the delta between fair market value and our strike price is fairly substantial.
Yeah.
So working with a CPA and a lawyer to try and figure out how to do that in the most efficient way possible is definitely part of the plan.
Yeah.
But we haven't gotten there yet.
Got it. Yeah. It's interesting, right? Because, I mean, you deserve, I'm just looking at it and going, okay, you deserve the money. How do you monetize that if you put them into the fund at the strike price? The fund's worth a lot more. And if you got enough percentage, maybe it's worth it. But yeah.
Yeah. And I think one of the things that I'm thinking about too is I'm still relatively young. I see this as my long-term career. If I can really, maybe not make as much money, not cash out the chips,
Sure.
kind of not make as much money on the fund the first go around, but have those returns for the investors and the people that kind of trust me to put money in this fund, and like have it as a chip on my resume. Like, not only did the restructuring of the first fund, because I gave a lot of the equity back, do pretty well, so I can kind of push that out as a resume chip, but then seeding the second fund with these really, really good deals, like the track record is starting to build where it's like, I can go show my resume to larger and larger capital partners.
For sure.
And be like, this is the track record of the first fund. We gave equity back to really flush the investors. Like, this is the track record of the second fund. We seeded it with these really, really good deals, and I didn't skim off the top. Like, I'm going to be a really good steward of capital.
Yeah. I like it.
Yeah.
I think that's a great way. I think that's a great ending, isn't it? I mean, is there anything? Yeah.
I got nothing, man. That's a very cool story. Hopefully we'll keep in touch after this. And thanks for doing the pod.
Yeah.
Appreciate it.
Yeah,
I appreciate
thanks.
you guys
Cheers.
having me on.
What's going on today, Tim?
Man, gosh, lots going on lately. It's been, getting ready for the holidays, but also just like lots of stuff, lots of loans closing out. Thanksgiving was really busy for the team. And now we've got all the people who didn't close before Thanksgiving, picking those files back up and getting stuff finished out. It's an interesting time of the year for mortgage.
It's a funny push right now, right? Like, I don't know. I feel like things were really dead August, September, October. Not a great time to list a home. But I've encountered time after time multiple offers over the past month.
Mm-hmm. Well, we've have some clients that have lost out in multiples, right? That we're working with, where they're having a hard time buying a property because it's hotter than people think. Yeah.
Yeah. So it's not like I wouldn't recommend, if you're thinking about listing your house, now's a great time. I wouldn't quite say that.
No.
But there's still certainly deals to be found.
The right properties, right? Like, I mean, again, like I'm thinking of one in particular, the one over in Roseville, that property that was the triplex.
Yeah.
Very good deal. I mean, like, he lost out on a good deal. This wasn't like something where it's like, oh, we're trying to make it work. It actually worked, right? So, if you have the right deal, there is some interest out there.
Yeah, definitely. And I would expect, I wonder if it means, usually like January 2nd is a really busy day for me.
Yes. Busiest day of my year is often the first business day after January 1st, right? The phones ring off the hook.
Exactly, man. And so I just wonder if, since we're already cooking right now, when typically Thanksgiving to Christmas is the most dead, if we're cooking decently right now, I think maybe January 2nd will be even bigger. So, you're thinking about selling this spring, maybe prepping for like a, February 5th, 6th, 7th, first Friday after the Super Bowl listing, I think is going to be pretty sweet this year. That's my prediction. This will be on the internet forever. We can let me know if I'm wrong.
Love to see it.
Anything going on with you, real estate wise? Oh, how's that new construction deal going in Frogtown? Are you doing that?
Yep. I'm going to be going over there to meet my private money lender later today.
Okay.
And I expect to close that. I believe our closing set up for December 19th, if I remember correct. And I expect everything to go off without a hitch.
Sweet.
Not a lot to say about it yet. We're actually still working on final numbers. There was a little, in real estate, you have these little hiccups, and whether the box was jammed or frozen or something, but like we tried to get the contractor in there for final measurements and stuff, and that didn't happen right before. It was like a couple of days before Thanksgiving, and we couldn't get in there until yesterday. So now we're back in and we're working up the final details, but nothing too earth-shattering to talk about on that. Yeah.
Cool. Yeah. I got the hoarder house is listed for rent. What else? Yeah.
I have something that came up yesterday with one of our joint clients, one of the podcast listeners. Him and I were meeting, and we worked through a couple of deals, and he was in the mindset that he was going to buy a duplex. But we ran the numbers on a duplex, and frankly, they at least on the ones that we had talked about, wasn't worth doing, right? It was like, if it was a deal analysis deal, it was thumbs down. And it wasn't hard to say that, like, that there was no real gray area. This was a flat out no. And we ran on a couple of deals, and then he mentioned a fourplex. And I said, well, let's run it on that, right? We ran it on 2 different fourplexes, both of which he looked at. And one of them was, let's say, arguably possible to do, but I think a little bit of a stretch, like not a great deal. The other one, I said, if these rent numbers are correct, this is a no-brainer and you need to run out to this property. So your first thing is to make sure that these rents are actually correct, right? Because if these rents work well, then you need to buy this property. And so the reason why I bring it up is I think that, like, if you're just out there and your mind is on one thing and you're not talking to a professional like Adam or me or someone else, maybe James or whoever, then you really could be missing out on the boat. So we're seeing deals all the time that happen. I mean, that one, our client missed out on one. This fourplex that the other client mentioned, but really thought he couldn't buy, right? And by the way, he couldn't buy it with his thinking. He had to talk to me where I was like, no, this is how you would do it. And all of a sudden it opened up the door to a possibility. So I think a lot of people get stuck in their own homes staring at spreadsheets and not really talking to enough investors. It doesn't have to be Adam or I. It could be at a meetup, talking to someone else. They'll give you an idea. They'll open up your mind. Yeah.
Just talk to somebody who's doing deals right now. Yeah. That's the thing. You can't talk to someone who the last deal they bought is in 2022 or 2021. And honestly, cash flow numbers have gotten better since then. But I think what we can bring to the table collectively, people that are in it right now, is we can let you know how good of a deal the market will allow, right? Because we between the two of us, maybe we've seen 100. I don't know. You probably do a lot more transactions than me, but 100 transactions over the past few years that were analyzed, and then there's a spectrum of like okay deals where it's like comfortable enough, but it's a cool place, and so we're accepting that it doesn't look as great on paper.
Sure.
To like those home runs we can both think about that happened this year, and then where does your deal fall in that? And if you're expecting something that is outside of the spectrum, then we can bring you down to earth, and maybe you want to invest in real estate, maybe you don't. But I think that would be the most beneficial thing for someone who is trying to get into this.
Yeah.
What's realistic?
Yeah. My overall thought is just that, like, not telling you can or should buy, but telling you if you're just stuck at your house staring at a computer, and you're not out there actively talking to people who are closing on deals, you're probably missing out.
Yeah. I'm refinancing a couple places. I'm going to grab a HELOC on this house. I'm kind of getting some funds together, and there's a house down the street. This is going to be a theme. Remember, I got excited about that place on Summit a few months ago.
Yeah.
It's going to be a theme where I've been in this house for coming up on 3 years, and like as a like perpetual house hacker, even though it's like not a house hack at all, I'm like, I'm ready to
move on,
do something else, or just add value to something that's cooler.
Yeah.
And I have been blessed enough to buy cooler and cooler homes as I get older.
Yeah.
And now I want something cooler than this. And so,
so we're going to have a new set is what you're telling me?
Possibly. Well, hey, I wrote a soft offer the other day on a place that's a few blocks from here. So just picture like a cooler version of this house on a whatever. I can't wait to talk all about it if I get it, because the way the deal came to me and the circumstances of why it's a lot cheaper than you would think are really remarkable.
But you just can't talk about it now.
I don't feel comfortable talking about it online.
Yeah.
But it's exciting. It's one of those deals where I'm really excited about it. And then the person who's holding like the keys to the castle, this is priority like number 15 for him. You've been in this position before. Yeah. It's frustrating. So I'm just, I'm not bugging the guy. I send him an email every couple of days or whatever.
Yeah.
But yeah, I'm just looking for more construction projects, man. That's really what gets me. I went to, I walked through 1133 Hague to meet an appraiser yesterday.
Yeah.
And I'm like, damn, this house is so cool. It really is cool.
Yeah.
So yeah, we're gonna do a holiday mixer. I'll tell you what, this is definitely coming out on the 8th.
Okay.
This episode. And so go to meetup.com, search for our group, Twin Cities Real Estate Investing. If you're not a member already, we're just figuring out. Well, I mean, we'll know what the venue is by the time we drop this episode. So go to our Facebook group, Twin Cities Real Estate Investing, or go to the meetup group. And it's just a holiday social. That's what we're doing, right?
Yeah. Just like the backyard barbecue we did this summer, it's just a chance to just meet other investors and talk to them about what they're doing and really find out what's working for them. We'll invite a lot of the guests from the pod, as well as, which we had last time, as well as, everyone's invited. So come on out, and the more people are there, the more interesting conversations that happen.
Why don't we just commit to a date right now? What's the date, Tim?
I like the 17th. It's a midweek. Should be.
Is that a Wednesday?
Yeah.
Yep. Okay.
Are you good with that?
Yeah, that's fine.
All right.
December 17th, location to be determined. Go to Facebook or whatever to figure it out. Or maybe it's in the description of this podcast. Who knows? Maybe future Adam might be able to do that.
Go future Adam.
Thanks to RPM Viking. Make sure you reach out to them for your management leads. Thanks to Shook Rentals for being such a great supporters of all of our rentals and management. And thanks to Network Title for keeping things organized. Make sure to support our sponsors. When you support the sponsors, you support us, and then we can keep doing this and providing value to you guys. So
yeah, every one of them gives you a deal for mentioning the podcast. They have codes, but frankly, if you just tell them if you at least mention the podcast, you're going to get a deal. Most of them are like REI 20 or something like that.
Yep. Check it out in the description. All right, see you guys.
Thanks.
Bye-bye.
Bye.
That's it for today's show. You can visit the Twin Cities Real Estate Investing.com website for show notes, tips, tricks, and other local real estate investing information. Adam and Tim would like to meet with you. To schedule a one-on-one meeting with either Adam or Tim, go to TwinCitiesRealEstateInvesting.com/schedule.